Hello everyone, welcome to another edition of #AskRobCo with James Wild as always this week. How are you doing, James?
Yeah, really good. Thanks, Rob. How are you?
Yeah, really good. Been running around, very busy. So we'll go straight into it. Thanks everyone for joining. As you do every week, great audience, great participation, great questions, and great data and intel and market updates for you this week. Just to go through what we went through last week, we had the cladding guidance note provided by the RICS. Anyone that didn't receive that, please contact us and make sure you do get that. Why is that so important? Because the guidance note shows very clearly what the updates are in terms of requirements. And what I like about it is it has a case studies of property type, and then explains very clearly what's required, when something's required, and what's not required. So please everyone, especially those in credit and lending, contact us. We will send you the guidance note just so you can see the case studies, so you can see what's required for an 1880s Victoria building, nothing. What's required for a 1960s, 70s building, depending on what it is and depending on how many floors and the height and so on. So once you've got that sitting on your desk, at least you know what the guidance is and you can visually see it. That was really good last week, cladding update. We also went through all of the budget updates and we discussed how it would impact each part of the industry and all the different sectors. And obviously that's a moving piece, and we're going to see as the weeks and months go by what real effect those budget policies will have on both the commercial and the residential real estate market in the UK. And obviously we went through the data last week, and that is where we're going to start this week as always. And we have some very good headline data, very positive. So if you go to the handout on the right hand side, handout 1, the week 10 sales and data for 2021. And we've redesigned it a little bit. Some of the feedback we received from everyone was that they couldn't see clearly enough some of the data and some of the intel. So we've just played around with it, but any changes you want, you tell us and we will give you that information. So let's look at the headline information in terms of predominantly new instructions coming on stream, under offers, sold properties, the key data that we work off every week. Starting with the new instructions, I'm going to be really repetitive here. And the reason for being really repetitive is because the trend we are seeing is every week more and more properties are coming on the market. So it's why the instruction levels over the last few weeks are going up and up, to which the latest data is the strongest instructions level of the year. And I would say that coincides with schools going back. And I'm pretty confident in saying that when we get to the next stage of lockdown being lightened, 28th of March, Monday, if it's Monday the 28th or Monday the 29th, when that day starts, you'll see more properties come on. And then after Easter, schools go back and the world starts to become a bit semi-normal again. You're going to see more properties come on the market. So we're now looking over the next 3 to 5 week period of steady, strong new instructions. And that is what all the agents are telling us on the ground every week. And what you're seeing is that perfect translation here. You know, this data may be live and we may be giving it to you on a weekly basis. And also we're reflecting what we're seeing in our work, because we are really the pulse or the heartbeat of the industry from a valuation perspective, because when we're busy, it's a perfect correlation and reflection that the market is busy. That's ultimately how the industry operates. And what you see with the under offers and then the sold figures is there's no surprise that last week saw the most under offers of the year, on the back of more instructions coming in, on the back of lockdown restrictions being softened. All of that naturally leads to gradual increase, to which the sold figures of this week are the 226 number, which is the second most we've seen of the year, but very consistent numbers and very strong numbers. If you understood the averages of last year and the previous year, very strong averages, and we expect those averages to continue going upwards with small increments. So the trend is very, very clear. More instructions equal more under offers, equal more sales, and we expect that trend to gradually continue and remain robust and strong as lockdown restrictions soften, and then all the incentives from the budget of your 95% mortgages, of your stamp duty windows will continue over time. So I think that's a positive trend. And for all of those in underwriting and in legals, in conveyancing, in risk, in banking, in finance, in sales, in agency, in valuation, we are just going to come under quite a bit of pressure as timelines drift, because the volumes reach the same levels as they were at the back end of last year. And ultimately, most of the businesses in that food chain cycle for the property industry don't have enough woman or man or human resource power to deal with that. So timelines slip along with searches and land registries, but all positive data in a good direction. James, anything I've missed there or anything you want to add?
Yeah, just a few points. Thanks, Rob. Obviously, we can see now that we've got the graph just to graphically display some of our data which we've been bringing you. The new instructions are certainly on the rise, and these have spiked since the 24th of February, as we can see in our graph there. This obviously coincides with Boris Johnson's roadmap out of lockdown, which I believe was on the 22nd of February. So a nice bit of data there, which obviously is very reactive to the government's position on coming out of these restrictions. Like you say, I think the most telling time is going to be sort of the first, second, third weeks in April, where the market is going to fully reopen, and we possibly expect those new instructions and with some pent-up demand to certainly come close to those levels which we saw in Q4 2020. So that'll be again one to watch. And with this new stock coming online, which we are anticipating, how the sold number of properties, those transaction volumes, how they react, because at the moment there is that sort of slight stock shortage, how we're seeing against the previous data. So that would be that increased stock on the market will allow the possibility of the market to further flourish, to sales to go through. This will be aligning with some of the policies of the stamp duty holiday extension, some of those buyers making the sort of full use of that scheme before its full closure at the end of September 2021. So I just thought I'd pick up on those couple of bits just in terms of those indicators, our data, just reacting off some of those bits of data and information, such as the roadmap and the budget, which we brought to you a couple of weeks ago.
Thanks, James. Not to sound like a broken record, but I think now is a really pertinent point for the risk and credit and sanction teams on this call this week. It is very clear that we're seeing in the pockets of both locations and property type that are now more in demand because of COVID. So we are talking about predominantly flats or apartments with outdoor space, and houses with a better footprint, and again, good outdoor space in those good green villagey locations, both in town, out of town, and home counties. So broadly all of those areas. We're clearly seeing strong demand in certain property types, the ones I've explained, which in turn creates sometimes a premium scenario, which can happen via demand and supply. So maybe 3 or 4 applicants bidding against each other and someone wanting to secure a property and to do that they've paid a higher price or got involved in a bidding war or paid a premium. Or what's more common in the 2021 market is a premium being paid for a property that's off market, and thus the exclusivity of being the purchaser that gets to see that property because you're not competing with the rest of the market would mean that you will be required or asked to pay a premium for that exclusivity broadly that you're receiving. So I think caution to the wind, credit risk, underwriting, sanction, sales teams as well, is that it's okay for someone to pay a premium. It's okay that that's what we're seeing at the moment. The challenge we all face is to ensure that, one, there's good transparency within that, and that means that the stakeholders behind those transactions, that could be the broker, the mortgage provider, the sourcer, the finder, the agent, the buyer, the applicant, the lender, the valuer, are all either aware or make everyone aware that actually, you know, this is 10% or 15% above market value. And if everyone is comfortable with that and everyone understands that's what they're entertaining and everyone is happy to proceed with a deal on that basis, so be it. I think everyone has to be aware that that is a natural repercussion of the current circumstance that we're in, and that's the trend that we're seeing, and I really want to highlight that. And again, anyone that wants to have a conversation off call around that, I'd be more than happy to do that, because I think over the next 6 to 9 months you're going to see that a lot, and how that gets managed in a positive, good way is really important. And I think I just want to share that with you, because we're seeing it more and more now as the market strengthens on the back of lockdown being softened. And you know, we have a responsibility to all stakeholders in the industry, all of our partners, everyone we're working with, to make you aware that premiums will be paid, and that's okay as long as all parties and stakeholders have that transparency. James.
Hi, thank you, Rob. I just wanted to do a bit of a high street special today, especially on the back of some of the news coming out of the budget, and obviously the £5 billion which is being put towards the bailout and supporting of the high streets. So straight into some of the news. So shopping centre owner Hammerson is hoping that the British public and some of the tourists start to come back to some of its shopping centres as lockdown ends and starts to ease over the next month. Some of the company's main sites, Hammerson, they have the Bullring in Birmingham, they have Brent Cross here in London, and they also have Cabot Circus in Bristol. Share prices in the firm, interestingly, in the last week or so, these have jumped 13%, whilst furthermore it's seen a roughly 100% increase in its share price since Boris Johnson outlined his roadmap out of lockdown, making it one of the best performing companies in the FTSE 350. Just a background point for you there, with obviously some positivities and more investors into those companies. Furthermore, go on, sorry, Rob, your reaction to that.
Yeah, I mean, I was just going to say, going on to the high street, and yesterday's announcement from Greggs, I thought that was a really interesting one. I think they reported either their first losses, was it, in 30 or plus years, and at the same time that they announced that they're looking to open another 100 units. Is that right?
That's right. Yeah. So I was just kind of come on to Greggs. Actually, it's their first loss ever reported as a listed company for 37 years. So obviously a massive blow for them. The company has outlined plans for a further 100 stores, as you say, which would create around 1,000 jobs. Just to give you a bit of background on Greggs, they've currently got 2,078 stores across the UK. And just in terms of its high street presence, to outline, McDonald's has around 1,300 stores in the UK. So just outlining its presence really. I think Greggs' strategy is going to be petrol station forecourts, motorway service stations, whilst also there's going to be some expansion in half a dozen, as they say, sites across the City of London, which has been somewhat aided by some reduction in rents here in London, and also the stock availability, whilst they've also rolled out their delivery service through Just Eat to 600 of their sites. So some expansion there from Greggs, which they're looking to perform and undertake over the next 12 months. Some further high streets. Oh, no, sorry, Rob. Carry on.
I think they've really got their pulse on the market, and I think it's a big confidence booster, because ultimately Greggs' model is an absolute footfall model. You know, there's no two ways about it. Very low margin at the very bottom end of that sector, and they require volume and footfall or carfall if it is a petrol filling station or roadside. And so I think strategically they run a very smart project and program and business. And I think it shows you that even in the depths of lockdown and crises, you can model positively and have growth in areas where at the moment pretty much they're seeing the lowest footfall and drive-through that would have been seen historically. And I think to everyone out there that is concerned about both high street and retail, I think good businesses will always be good businesses and will always adapt to scenarios and re-emerge from crises in a strong way. And I think I'd love to watch how Greggs perform, and it'd be great to see their numbers a year from now and how that growth has taken place. So thanks for that, James.
No, thank you. They also did obviously have some PR in the summer with the launch of their vegan hot sausage roll, which I did sample. It was pretty similar to their more usual pork sausage roll. Side point there. Moving into more central London and the sort of prime retail offerings of Oxford Street, the luxury fashion brand Hugo Boss has taken 8,000 square feet at the former Selfridges, the Parcels building on Oxford Street. Whilst we do understand their flagship store will remain at 178, 180 Regent Street, very close to Hamleys, just on from there. But some more positivity, a large UK clothes brand obviously taking a good amount of space on Oxford Street. Some positivity, some positive sentiment there, definitely, Rob.
Excellent. Okay, so from my side, and for those that you possibly joined late or missed the message, the volume now is ramping up in all aspects. We're going to see the return of commercial this year that really got decimated in 2020, and slowly but surely the commercial offering is going to strengthen. Obviously the return of the high street in April, to the more functional return of the high street in May, and the fully functional return of the high street in June. So everyone who has commercial exposure from a lending perspective, that's going to strengthen month on month on month through 2021, and we're already seeing that. It's already starting slowly but surely. In pure residential space, again, that's getting strong again, and we expect that to have a really strong 6 to 9 months. And I know all of the teams that we speak with on a daily basis are sharing that with us. So they've got very good volume and increased volumes coming, which is going to put a lot of pressure on the industry and all the facets, because to work with that volume of business that's going to be coming through, and the new deals or new applications or new mortgages or acquisitions or refinance is just going to be challenging for everyone. So, you know, everyone be prepared, because it's happening, and it's happening now. That's not a question mark or if or a maybe. It's happening, and we're seeing it. So we're normally the first point, and then it obviously spreads. So be prepared for that. And the upturn of commercial means that you've got two more vibrant markets working simultaneously, commercial and residential, the return of the high street, as James has just mentioned, it's going to be really strong. Any other news you've got for us for today, James?
Yeah, please, Rob. So, not a traditional high street retailer, but Amazon have obviously created quite the stir on the high street in the last month. Yesterday, they opened their second till-free supermarket in the UK, in Wembley, following the success of its initial store in Ealing, which opened its doors around a month ago. The stores are the first in the UK with a just walk out policy of shopping. I haven't been into one yet. I have witnessed the queues outside the one in Ealing. I think it's on the mall just off the Broadway there, and the queues were round the block. It was interesting. There was more staff outside than inside managing the queues, than obviously no checkouts. So one which I think we're going to see more of Amazon on the high street, it seems. Obviously, we did see a non-high street store opening up a year or so ago, just testing the waters. IKEA near our office on Tottenham Court Road, offering more of a sort of a showcase of some of their furniture layouts, and offering something in a more central location than some of their sort of traditional out-of-town sort of retail warehousing stores.
I think the Amazon position is so interesting, and it's a fascinating one, because ultimately they want an end-to-end production line. And if we understand logistics is the best performing commercial sector within real estate currently, and remember, I keep repeating over the last few months that last mile logistics is going to be a game changer. And last mile logistics is going to be, you've got your big hub, out of town or in the Midlands that your distribution hubs, and then you've got your last mile hubs that are in city centre locations, which allow for very quick distribution from the hub to the home, or from now the Amazon supermarket, and to get the fresh product and to have very quick distribution and turnaround. So this is a real change in dynamics now. It's not just you've got a supermarket and basically you're getting your distribution from company X or company Y. You've got Amazon who are now saying, well, we are the distributors, or we are the supermarket, and we are logistics, taking over all facets of that supply chain from top to bottom. And that's a real disruptor. That's a disruptor that we wouldn't have seen arguably in that space since, you could say, your Lidls and your Audis started challenging your Sainsbury's and your Tesco's about offering a more competitive price point in the market. Now there's a distribution change in terms of we can have a seamless, frictionless supply distribution chain and go direct to consumer, because Amazon is the brand and we do everything. And they would be looking to take over the world in that sense, because they feel that they've got everyone on their database and client base. And I think from a real estate perspective, that is going to be a fascinating area to look at over the next 10 years. Last points for today, James, what else have you got?
Well, just we did know yesterday, Thornton's obviously announced that they would be closing at 61 stores on the high street. We're not quite sure what's going to be happening with their sort of business, whether it's moving online. But obviously that is a great shame, having a presence on the UK high street for the last 100 years.
Yeah.
But they've obviously seen increased competition the last 5 years or so. There's been new entrants to the market, such as Hotel Chocolat, which is obviously, no pun intended, eaten into some of their market share.
Brilliant. Anything else for today, James, before we wrap up?
That's it from me.
Brilliant. Thanks, James. The final point for today, and thank you for everyone for your comments, your questions, and supporting across all the platforms. the market is moving so quickly that the fact that we can be here week on week, and we're coming up to our 1-year anniversary soon, and the fact that there's so much data and intel, and the market is such a fast moving market, and at the same time we're in a lockdown and nothing's moving, it's such a 2021 reflection of markets, industries, performance, and property. Things are moving quickly. The data is there, and we're just going to carry on feeding you everything that we're seeing, and hopefully allow you to make better decisions for your lending and your sales, and for your risk and for your credit, and we will carry on doing that week on week on week on week. So thanks everyone for joining. Any other data, intel, documents, information, if you want the guidance for the cladding, please reach out to us. I'm not sure, I think we said we're going to send it to everyone. If we didn't, come to us. It's a really good document for you to use as your guideline. If you need more data and more intel, let us know. And we're doing loads of property valuation market updates on Clubhouse at the moment. It's a really interesting space for the lenders. I've been doing a couple of weekly shows where we've had a good 6 or 7 lenders talking about product and pricing and your 95% mortgages and your HMOs and your buy-to-lets. It's a fascinating open discussion platform where a lot of lenders are there, and you know, a lot of CEOs or MDs of the lenders are there. I think it's a great platform, a great discussion space, and I strongly recommend to join some of those rooms, and I'll probably share some of that information on socials, because I think that's a real one to watch. So Clubhouse and property lending, product pricing is a great one for this audience as well. All right, thanks everyone. Have a great week. Anything you need to know, please contact us. Thanks, James, as always, for your great input, and we will see you at the same time, same place next week. Thanks everyone. Take care.
Thanks very much, everyone.